5%. That is roughly what banks can earn today on risk-free U.S. government debt. Now, look at your savings account. Almost zero. That gap is not an accident. Your money earns the yield, the bank keeps the spread. For decades, you had no alternative. Then stablecoins changed the equation. A digital dollar backed by treasuries could pass that yield directly to you, and the banks recognized the threat. So, on February 2nd, 2026, top banking leaders went to the White House as the new market structure bill took shape. The public message was safety and consumer protection. But inside the proposal is a critical push: ban interest-bearing stablecoins. Not the technology, just the yield. Because a digital dollar that pays nothing cannot compete with the banking system. This is not just regulation, it is a battle over who gets the return on your capital. Hi everyone, you're watching Global Macro and Crypto. Today, we are going to expose the regulatory moat being built around your capital, and why the war for yield may become one of the most important macro conflicts of this decade. Because beneath the policy language, beneath the headlines, a simple question is emerging. Who gets paid for your money? To understand what is unfolding, we have to look past the political theater and into the plumbing of the financial system. For over a century, modern banking has relied on one quiet behavioral advantage: sticky deposits. Banks are not just holding your money, they are counting on your inaction. Not because moving money is impossible, but because historically, it has been inconvenient enough that most people simply don't bother. And that inertia is enormously profitable. It allows banks to pay you near zero, while lending the same capital out at multiples of that rate: 6%, 7%, sometimes more. The spread is not a side effect. The spread is the business model. So, if banks need your inaction to survive, what happens when technology removes that inaction? Deposits are the raw material. Net interest margin is the engine. But something changes when interest rates rise. When cash starts earning real return again, people begin to look closer. They compare. They calculate. And once depositors start doing the math, deposits stop being sticky. For years, the closest alternative was the money market fund, but it settles slowly. It behaves more like an investment than spendable cash. You don't buy groceries with a money market fund. You don't send one across the world in 10 seconds. Then the system encountered a technological shock: tokenized treasuries, yield-bearing stablecoins, assets engineered to behave like cash, but earn like government debt. They settle nearly instantly. They are programmable. They move across borders without friction. But the real disruption is simpler than all the technology. They collapse the spread. For the first time in modern finance, the risk-free rate no longer has to stop at the bank. It can flow directly to the holder. And the moment that became credible, the entire deposit model faced a dangerous question. If your digital dollars can earn what treasuries pay, why would you leave excess cash in a traditional bank? That is not a product question. That is an existential one. Existential threats rarely trigger passive responses. They trigger lobbying, which helps explain why some of the most powerful banking executives in the world showed up in Washington as the new market structure bill began taking shape. Publicly, the discussion centered on safety, stability, consumer protection, language no policymaker would oppose. But inside the draft conversation sits a far more consequential idea: a push to prohibit interest-bearing stablecoins. Not ban them outright, not outlaw the technology, just remove the yield. Because a digital dollar that pays nothing is no longer a threat to deposit funding. Call it what it resembles: a yield firewall. Now, the argument being presented to lawmakers revolves around something you will hear more frequently: the so-called shadow banking loophole. The claim is that stablecoin issuers are performing bank-like functions without carrying bank-level regulation. On the surface, it sounds reasonable. After all, financial history is full of structures that looked safe until they weren't. But step back and compare the balance sheets. A compliant stablecoin issuer typically holds 100% reserves in short-term U.S. Treasury bills, among the deepest and most liquid markets on Earth. Transparent, marked daily, highly collateralized. Now, contrast that with many traditional banks. They hold long-duration loans, commercial real estate exposure, securities that can become extremely difficult to price during stress. We were reminded of this in 2023. The system looked stable, right up until the moment it didn't, which raises an uncomfortable possibility. Restricting yield on fully reserved digital dollars may not be about reducing risk. It may be about preserving funding. Because if stablecoins are forced to hold reserves inside the banking system rather than directly in treasuries, you introduce an additional layer of counterparty exposure. You take a structure designed to minimize fragility and reconnect it to one that periodically requires rescue. That is not necessarily risk reduction. It is risk relocation. The proposal itself is deceptively simple, non-interest bearing. Issuers can earn the yield, custodial banks can earn the yield. But the person actually holding the digital dollar? Zero. Pause on that for a moment. The yield exists. The system just redirects it away from you. History shows a familiar pattern here. When a new technology becomes dramatically more efficient, incumbents rarely win by out-innovating it immediately. They slow it down. Railroads resisted trucking, telecom resisted internet calling, media resisted streaming. Finance is unlikely to behave differently. But the macro implications extend well beyond bank earnings. The United States now carries debt measured in the tens of trillions, and sustaining that debt requires consistent global demand for Treasury securities. Stablecoins have quietly become structural buyers. In effect, they operate like automated channels funneling capital into government bills, which creates a policy tension. The Treasury benefits from that demand. Bank regulators worry about deposit displacement. One arm of the system needs the buyer, another fears the competitor. And investors sit directly in the middle of that push and pull. So, what happens if yield is restricted? Markets tend not to eliminate incentives, they reroute them. The most likely outcome is a bifurcation. On one side emerges a fully regulated environment. Think of it as the whitelist. Compliant stablecoins, seamlessly integrated into payment infrastructure, accepted everywhere from payroll systems to tax portals, but economically inert. If inflation compounds at 3% and your digital cash earns 0, the arithmetic becomes unavoidable. Safety turns into a slow confiscation of purchasing power. Capital rarely tolerates guaranteed erosion. Which brings us to the other side of the split. Call it the gray market. Though in practice it may simply mean friendlier jurisdictions or decentralized rails. Because capital has a defining instinct, it migrates toward yield, always. Institutional money understands this reflexively. Sovereign funds understand it. Increasingly, sophisticated retail does too. When real return disappears in one environment, money does not argue. It moves. Singapore, Hong Kong, emerging Middle Eastern hubs, on-chain credit markets. And here we encounter the regulatory paradox. The tighter the controlled perimeter becomes, the stronger the incentive to operate beyond it. Ban yield in the regulated layer, and you may unintentionally accelerate liquidity into decentralized finance. Not because participants are ideological, because they are rational. Yield is not a luxury in capital markets. It is gravity. If regulated platforms cannot offer it, alternative architectures will. Harder to supervise, harder to tax, harder to influence. In trying to shrink the shadows, policy can sometimes lengthen them. And beneath all of this sits a deeper institutional concern. Banks do not simply sell products, they anchor the payment rails. If wallets begin to function as both transaction accounts and treasury ladders, the physical branch stops looking like infrastructure and starts looking like overhead. Real estate is expensive, staff is expensive, legacy core systems are extraordinarily expensive. Smart contracts do not require marble floors. The efficiency gap is no longer marginal, it is structural. And structural gaps are rarely closed by competition alone. Often they are mediated through law. Up to this point, this looks like a fight between banks and crypto. But zoom out, and this becomes a question about the future of the dollar itself. There is another dimension that deserves attention: geopolitics. The dollar's reserve status ultimately depends on global willingness to hold it. Why hold dollars? Stability matters, liquidity matters. But yield matters too. Now, imagine a world where US digital dollars are mandated to pay zero, while another major currency allows interest-bearing versions. If you are a corporate treasurer in São Paulo or managing export flows in Jakarta, the decision becomes mathematical rather than political. Money tends to choose the instrument that compensates it. Policies designed to shield domestic banks could, unintentionally, dilute the dollar's competitive edge in a digitizing monetary order. That is not a quarterly risk. That is a generational one. What we may be witnessing is a state-level version of the innovator's dilemma, protecting the present at the potential expense of the future. So, where does this path lead? Two scenarios appear increasingly plausible. Scenario 1, the hard line. Yield is prohibited outright. Regulated stablecoins evolve into pure payment conduits, used briefly, held sparingly. Capital passes through, but does not reside. Where does it go? Bitcoin, tokenized commodities, real-world asset protocols, on-chain credit markets. Attempting to suppress return in one layer can ignite risk-taking in another. Liquidity does not like ceilings. Scenario 2, the tiered system. Yield survives, but selectively. Institutions qualify. Accredited investors qualify. Retail does not. A two-speed financial architecture emerges. One tier compounds. The other slowly falls behind. Historically, gaps like this reshape behavior, often pushing smaller investors toward higher volatility simply to keep pace. Neither scenario perfectly aligns with the ideal of an open financial system, but both reinforce a single underlying truth. The yield is still out there. What is changing is access. Tokenization has quietly separated two functions. Money once fused together, payment and store of value. In the old model, the same account handled both. In the emerging one, you may transact in a stablecoin, but store wealth somewhere entirely different. Efforts to force those functions back into one container may delay the transition. They are unlikely to reverse it. Expect turbulence around this debate. Expect strong rhetoric, crackdowns, enforcement, systemic risk. But when incumbents reach for the legal framework instead of competing on efficiency, it often signals something unmistakable. The challenger is no longer hypothetical. This is not merely a regulatory story. It is a signal that real yield may be migrating, away from institutions that historically captured it, and toward architectures built to distribute it. The banks want to preserve the spread. The code is designed to compress it. That tension is the story, and the outcome of this legislative battle may help determine who captures the wealth generated by the global financial system over the next decade. In the next video, I'll break down why institutional investors are beginning to reassess dollar exposure, and where capital moves when confidence in fiat starts to fade. Thanks for watching Global Macro and Crypto. I will see you in the next one. If this added clarity to your perspective, hit like and subscribe. Now, let me ask you this. Would you prefer a safe government-approved stablecoin that pays 0% interest? Or would you take the risk of moving your capital into DeFi to capture a 5% yield? Leave your view in the comments below. This content is for educational purposes only and does not constitute financial or investment advice. Always do your own research.